We're starting off in California. Talk with Stephanie. Stephanie, you're with Allworth's Money Matters.
Hello, how are you?
Hi, Stephanie.
Trying to make a decision about long-term care insurance. Our assets seem to be right in that spot where it's not very clear if it's a good idea or not.
Oh, this
so
is
use
these.
some help.
I hate these questions.
Well, it's like you're in California, right? So it's like, should I buy? Like, how do I get fire insurance on my home right now? It's like it's so expensive. So, how old are you, Stephanie?
So I'm 57. I'm married. My husband is 65. So the age gap was one consideration that I thought might weigh into it. The other factor is we don't have kids, so I know it's sometimes positioned as a way to protect assets for a guaranteed inheritance, but that's not a priority for us. We're trying to spend all our money.
Okay.
And do you have any pension income, guaranteed income that comes in regardless of what's happening?
You know what? Social Security at some point at about $5,500 a month, and some small pensions that add another $1,500.
And then what do you have in retirement savings as far as IRAs, other mutual funds, bank accounts?
So I made a list here. I got preferred comp is at 1.3 million, IRA 401k 1.7 million, 70,000 in a Roth, about 100,000 mutual fund, and 500,000 cash. We kind of have that reserved for a retirement home that we're building in Japan.
Wow.
So you have approximately $3.7 million.
Yes.
And then what was the preferred? What was that?
Not
The
preferred.
1.3?
You meant deferred comp.
Yeah, deferred
Okay.
comp.
I'm like, this is.
Is it in a 457 or is it from a private company?
It's a private company,
Okay.
executive.
Okay,
plan.
an executive deferred comp. Okay. 3.7. And do you own a mortgage?
House is paid off $600,000.
And when you build this home in Japan, will you sell your house in California?
No, we'll use it. You know, there's some resident restrictions over there, so.
And
we've
have
heard
you
it's
have you
difficult to
priced into some long-term care? Because it's primarily, I'm thinking your concern primarily, I would guess, is that your husband, something happens to him, it's many years, and it drains your financial assets.
Yes.
Yeah.
So I was looking if there's a strategy. You know, does self-funding make sense, or is there a strategy with insuring one of us that might be a little more reasonable that provides some coverage? I know it's hard to tell who might get.
So I would look at you
Have you shopped it at all?
No.
Okay.
So
So
do you know if he qualifies for long-term care insurance?
He should qualify.
Okay.
Yeah, but I mean the window is getting.
Yeah, I get it.
smaller, right?
Right, I understand.
So I'd look into it. You can afford it. You can you could go either direction on this.
Yeah.
That's why I'm calling.
Here's what you want to look at, and we don't know the cost because, I mean, there is 10% of the number of long-term care insurance policies written today than there were 25 years ago.
Because so many people have exited the market. The insurance companies have exited the market because they lost so much money on this for two reasons. One is low interest rates, which is how they reserve. And the other is because of adverse risk selection, oftentimes having to do with massive employer plans.
So, and the reason there's not many people buying them today, a lot of companies have exited, and people go to shop and they're like, oh my gosh, how much you want to charge for this? I think I'll just take my own chances. So that's why I think it'd be important to look at some. I would look at two different types of policies. One is a standard policy that has a long, they call it an elimination period. Is that what they call it?
Elimination period.
Think of it like a deductible on your car. You probably don't have a $250 deductible on your car, would be my guess. You have a higher deductible because you're like, I'm only going to wait until something really major. It's the same kind of concept. So considering that most long-term care needs are shorter, I think the concern is it's like a 10-year something, right? That's where it's a real problem. Most are shorter. So if you self-insure for the short and then say, then I want a policy that's going to pay a lifetime benefit. Should something happen, my husband gets Alzheimer's and lives 15 years with Alzheimer's.
So as an
Worst case
example, I go into a long-term care facility. The insurance doesn't kick in until day 366 or 700 and 30.
Depending on how long the waiting period is.
Which is the elimination or a waiting period, right? So I've self-insured myself for a specific period of time, and then after that, and then the insurance company kicks in. The premiums, it pushes the premiums down because they know, the insurance company knows that most long-term care stays are less than 9 months.
Less than 9 months for men and less than less than 2 years for women.
Yes.
Okay.
So the second kind of policy you could look at, think of it like a single payment policy. And they're essentially life insurance policies, like a universal life. I don't know if whole life has it as well, I would imagine. Like universal life insurance policy where you put in a chunk of money, let's call it, maybe it might be 150 grand, 200 grand, depending on how much benefit you want to buy. And it's in a life insurance policy. If you need long-term care, they essentially start taking your money first. And when you've exhausted your dollars, then the insurance kicks in. And if there's never any long-term care needed, then when someone passes away, there's a death benefit equal to the amount of the life insurance.
The downside to these is the fact that
we have to put the money up.
You put the money in, you're going to have that money tied up forever, right? Which isn't even, I guess it's a downside. Maybe it's not in your situation.
Can you use IRA dollars to buy that?
I don't know.
I don't know either.
But they have plenty of money. You've got that money in the deferred comp that's actually going to be pushed out when your husband severs employment.
Is it a 457 plan or is it a deferred comp from an employer?
It's an executive deferred comp.
It's on a 10-year annuity payout.
See, so that's being paid out. So you can buy these things, and you have money in a brokerage account, you said as well. You can buy these things lump sum. What happens is my cash never grows in there. So if I put 150 grand in there,
20 years from now, it's worth 150.
It's worth 150. What the insurance company does is actually takes that money, the interest it earns, and uses it to fund their reserve for the long-term care. So essentially, you're doing exactly what these life insurance policies do, exactly what Scott just described with the elimination period. The difference is you know the outcome. The bad things is most of them are not indexed to inflation either. So those are the two places you could go. I would probably, in your situation, if I had a choice, I'd probably buy the life insurance policy if I bought one at all. But you can self-insure.
But until you know the price,
you can't make a decision.
Yeah.
But you're fine to self-insure. I mean, if your net worth was $2 million higher, I'd say, don't worry about it.
Yes, exactly.
Don't worry about it. If your net worth's $2 million lower, I'd say, don't buy it.
Because you can't afford it.
Because you can't afford
Yes.
it. But that's why I hate these calls, is because you're right. We
don't hate it's just, there's certain things in life that are really hard to.
Yes.
That's a really challenge to plan for financially because the cost can be so great that it pretty much says, if you want to put your whole retirement plans on hold, we can get you insurance so that if you need long-term care, you don't have to worry about anything. But then you have no quality of life until that point. So you're essentially saying I'm not going to have any quality of life the rest of my life.
Which is why I'd actually buy the life insurance one, because I know the outcome and when it comes. The downside is that they have no cost of living adjustment on it. But you've got plenty of money that you could tie it up and you could reverse it at any time if you wanted to.
Would you do one of these policies on one of us, which is sort of like making the middle decision and sort of hedging our bets, but not over?
But some of them will cover both of you as well.
Yeah, I'd look at that. But I don't see the need for you having long-term care. You've got plenty of assets.
Right. Yeah. Okay. Good.
All right.
No, that really helps. Thank you for taking the call.
Yeah, glad you called. Wish you well, Stephanie. And
appreciate you guys.
The only one I've talked to is saying they're building a vacation home in Japan. That sounds kind of cool.
All right. Yeah. Well, that's it's going to be pretty amazing. So.
Good. We'll come visit.
Okay, you're invited.
Thanks. Actually, I went to Japan a few years ago. I climbed Mount Fuji with my daughter and a couple friends. I loved Japan. It was we had a phenomenal experience. It was just a great experience. I'd like to go back to Japan sometime.
Okay.
But I have no intention of building a vacation home.
How high is Mount Fuji?
It's like 11 or 12,000.
And how long did it take you to climb it? It's not like rock climbing. You're hiking it,
You're
correct?
hiking, yeah. We started at the base of the mountain, which most people don't.
Like
and
like the base of the mountain is like not at sea level.
2,000 or 2,000 feet or something.
Okay.
I don't know. It took us, 8 or 10 hours or something.
Sounds miserable.
It was awesome. I had a great experience.
That absolutely
Super
sounds
fun, actually.
miserable.